Hey everyone, welcome back to Corporate Decoder, the place where we try to understand what companies are really saying in all those complicated reports they have to file. Today, we're diving into Greenway Technologies, and trust me, their latest report is a bit of a roller coaster. It involves ambitious tech, patents, and a constant struggle to stay afloat. Greenway Technologies is trying to make gas-to-liquid technology cheaper and more accessible. Think about it, turning natural gas into things like gasoline and jet fuel more efficiently. They envision smaller, mobile plants that can process gas right at the source, avoiding flaring and reducing waste. That's the big picture. Their special sauce, a patented gyroformer, sounds like something out of a sci-fi movie, but it's their key technology. They say it's better than old methods because it's cheaper, smaller, and can be moved around. They're also exploring making high-value chemicals, not just fuels, which could boost profits. A major piece of their strategy involves a partnership with the University of Texas at Arlington. They've licensed technology from the university, giving them exclusive rights to use some key innovations. This agreement is a big deal because it secures their access to important technology developed at the university. Now let's talk competition. Greenway isn't playing in the same league as giants like Shell or Chevron. Their focus is small-scale mobile solutions. They mentioned a few companies doing similar things in the US but claim their gyroformer tech is better. The problem is they need to prove it and get certified by a third party to be taken seriously. Adding a bit of strangeness to the story, they also own mining claims in Arizona. It's a holdover from a previous business they were in, but they're not actively mining, and they're looking to either partner up or sell the land to someone who will. It's like they have a foot in both the energy and mining worlds, kind of unusual for a tech company. Here's where the story gets a bit more tense. The report emphasizes that they are not currently profitable and are dependent on outside funding to stay afloat. The auditors, the people who check their books, even raised concerns about their ability to continue as a going concern. In plain English, that they are not sure the company can stay in business. This is a big red flag, meaning they need to either start making money or find more investors. Also, it's worth mentioning that the Securities and Exchange Commission, or SEC, has been asking questions. The SEC basically told them that they concluded that their disclosure controls and procedures are ineffective, which means the company needs to improve how it handles and reports information. This is a bit of a black eye because it signals some trouble making sure that their financial reporting is accurate and timely. Now let's look at the cold, hard numbers. For 2024, they had no revenue, let me repeat that, zero. Their net loss was about $1.5 million. While that loss actually decreased slightly, it is not a good thing. And they burned through about $444,000 in cash just to keep things running. Their working capital deficit, which is like the amount of money they owe versus what they have on hand, also widened to over $13 million. Their actual cash is just barely over $20,000 against total liabilities, what they owe to everyone, of $13 million as of the end of 2024. Those numbers paint a clear picture. They're burning cash, not making money, and relying on debt and stock sales to survive. Speaking of debt, they have a significant amount, largely from loans with related parties. One loan agreement, managed by someone connected to the company, accounts for a big chunk of that debt. The agreement allows them to loan up to $5 million, secured by everything the company owns, including patents and intellectual property. This is both good and bad. It's good that they can get money, but those assets are on the line if they can't pay it back. Looking at their auditor fees, they paid almost $47,000, which is pretty standard for a small public company. There have been some shifts in leadership. Robert Kevin Jones took over as president, and while he doesn't take a salary right now, that could change. Having experienced people at the top is crucial, but it also adds to the cost. Digging into who owns the company is also a good way to get a feel of how it's governed. Looking at who owns the stock, a decent chunk is held by the existing board, and there are a handful of people and entities who own more than 5%. It is good to keep an eye on how stock is being issued, because issuing stock can decrease the stock price. The board also has a few independent directors, folks who aren't part of the day-to-day management. Having independent voices on the board is generally a good thing because it can help keep things honest and fair to shareholders. The report lays out some serious risks. They worry about not being able to protect their technology, facing competition and changes in regulations. They also acknowledge that acts of terrorism or war could mess with their business. These risks aren't unique, but they highlight how fragile a small company's plans can be. They straight up said that their controls over financial reporting aren't effective. Basically, they don't have enough people or the right processes to make sure that their financial reports are accurate. Finally, after the period covered by the report, they sold more stock. That's good in one way since it gets them cash, but it also dilutes the ownership of existing shareholders. It is a balancing act. So what's the story here? Greenway Technologies has a potentially game-changing technology, but they're in a tough spot. The core issue they face involves money, they need it, and fast. This report is a mixed bag. Their auditors are concerned about the company's ability to stay in business and have had issues with the SEC. Overall, Greenway Technologies is a high-risk, high-reward situation. If they can get their tech certified, strike the right deals, and raise enough money, they could be a major player in the GTL space. But there are big challenges ahead, particularly financial stability and SEC scrutiny. It might be a company to watch, but investors should definitely proceed with a clear understanding of the risks. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate decoder videos.